The world has moved on from the flashy headlines. Maduro is in New York. The bombing has stopped. The cameras have packed up. But what just happened in Venezuela isn't an ending. It's a chapter in a much larger story. Because what we're seeing isn't isolated. Greenland, the Panama Canal, Canada, Venezuela. These aren't separate issues with separate causes. They're pieces of a global chessboard that most commentators are still missing. This isn't just about one man in cuffs. It's about who controls resources, who owns the critical trade routes, and who positions themselves for the decades ahead. Officials call it national security. Others call it economic containment. But the tactic is simple. Whoever controls supply chains controls pricing, and whoever controls pricing can squeeze out rivals. Today, I'm going to break down the economic logic shaping the Western Hemisphere. Not the personalities, not the politics, but the structural shifts that are quietly redrawing global markets. There are three forces that matter right now: who holds the oil, how the world prices and moves money, and China's rapidly growing economic footprint in regions long seen as America's sphere of influence. Let me show you what's really going on. Most coverage treats Venezuela like a flashpoint, but it's far bigger than that. What's happening there is part of a two-decade-old economic rivalry across South America. In 2024, China's trade with Latin America and the Caribbean topped $519 billion, a 40-fold increase from 2 decades ago. China is now South America's top trading partner, bigger than the United States for Brazil, Peru, and Chile. And this isn't just about buying and selling stuff. China's involvement includes loans, investment, and big infrastructure projects across the region. Ports, railways, energy ties. These economic levers create lasting influence. This is why the strategic value of Venezuela's oil and other resources isn't just a headline, it's a pivot point in a much larger global competition. The world has moved on from the flashy headlines. Maduro is in New York. The bombing has stopped. The cameras have packed up, but what just happened in Venezuela isn't an ending. It's a chapter in a much larger story. Because what we're seeing isn't isolated. Greenland, the Panama Canal, Canada, Venezuela. These aren't separate issues with separate causes. They're pieces of a global chessboard that most commentators are still missing. This isn't just about one man in cuffs. It's about who controls resources, who owns the critical trade routes, and who positions themselves for the decades ahead. Officials call it national security. Others call it economic containment. But the tactic is simple. Whoever controls supply chains controls pricing, and whoever controls pricing can squeeze out rivals. Today, I'm going to break down the economic logic shaping the Western Hemisphere. Not the personalities, not the politics, but the structural shifts that are quietly redrawing global markets. There are three forces that matter right now: who holds the oil, how the world prices and moves money, and China's rapidly growing economic footprint in regions long seen as America's sphere of influence. Let me show you what's really going on. Most coverage treats Venezuela like a flashpoint, but it's far bigger than that. What's happening there is part of a two-decade-old economic rivalry across South America. In 2024, China's trade with Latin America and the Caribbean topped $520 billion, a 40-fold increase from 2 decades ago. China is now South America's top trading partner, bigger than the United States for Brazil, Peru, and Chile. And this isn't just about buying and selling stuff. China's involvement includes loans, investment, and big infrastructure projects across the region. Ports, railways, energy ties. These economic levers create lasting influence. This is why the strategic value of Venezuela's oil and other resources isn't just a headline. It's a pivot point in a much larger global competition. Countries in the BRICS club, Brazil, Russia, India, China, and South Africa, are increasingly settling energy deals in their own currencies or in China's yuan instead of in US dollars. Venezuela, according to multiple reports, was moving toward tying its oil industry into China's cross-border banking system and pricing its crude in a mix of currencies with the yuan at the center. If that shift had taken hold, China could have bought Venezuelan oil without needing US dollars. Without that dollar demand, the value of the US currency would weaken. A weaker dollar would make America's massive debt far more costly to service. That's the real concern, not whether Venezuela could sell 1 million barrels a day to China, but whether a nation sitting on 300 billion barrels could prove it's possible to price oil outside the dollar system and thrive. That was a scenario the United States could not allow, so the government acted. At a recent press conference, former President Trump said U.S. oil firms would enter Venezuela, repair broken infrastructure, and extract wealth, with the oil going to other countries and to the United States as reimbursement for damages. A day later, Secretary of State Marco Rubio walked that back, insisting the mission was about better governance, not resources. But the split message tells you the real story. Trump was candid about the economic motives, and Rubio was smoothing the diplomatic edges. The truth lies in between. The U.S. doesn't need Venezuelan oil today, but it does need control over how that oil is priced and who benefits from it. America's goal, from this perspective, has been to keep those huge reserves tied to the U.S. dollar and to block China from establishing its own independent energy payment networks. This intervention wasn't about liberating Venezuela. It was about reintegrating it into a dollar-centered economic order and setting the stage for what comes next. And there's a layer most analysts overlook. This isn't merely about current oil markets. It's about positioning for potential future conflicts. I'm not saying war with China is imminent, but the United States is shoring up influence in its own hemisphere in case tensions escalate. Look at the pattern. Pressure on Canada over trade, renewed talk about Greenland's vast minerals, heightened emphasis on the Panama Canal and control of sea lanes, and now a direct operation in Venezuela. All these moves follow a clear logic: secure the home perimeter, control key supply routes, and keep adversaries from gaining footholds in the Western Hemisphere. You make sure your energy supplies are dependable, your trade routes are secure, and your neighbors aren't giving strategic advantage to rivals. Venezuela fits into that calculation. The goal isn't just to face off with Maduro. It's to make sure that if U.S.-China tensions rise, South America's largest oil reserves don't become a reliable energy source for Beijing. What's happening now is strategic preparation, securing resources, locking in long-term contracts, and shaping shipping and insurance networks before they matter in a crisis. Publicly, U.S. officials talk about the Monroe Doctrine, defending the hemisphere, and national security, language that plays well with American voters and sounds resolute. But beneath that surface, the core strategy is economic containment, keeping China from establishing independent access to key resources, and when economic pressure isn't enough, backing that with military force. So what does this mean for markets and prices? In the short term, the effect is limited. Venezuela's actual oil output is a fraction of what it once was, under 1 million barrels per day after years of decay and sanctions. So taking it out of current global supply doesn't dramatically move prices. OPEC members still have spare capacity, and U.S. shale producers can boost output, meaning the market can absorb the disruption without a major price spike. But markets don't respond just to today's supply. They price in future possibilities. What traders are watching is the expectation that U.S. oil companies could one day re-enter Venezuela, rebuild its crumbling infrastructure, and bring production back up. Analysts suggest a post-transition increase, potentially into the low millions of barrels per day over several years, if conditions stabilize and investment flows in. If that happens, and Venezuelan heavy crude is flowing again priced in dollars and processed by U.S. refiners, it becomes a real, long-term addition to global supply with consequences for pricing and regional refining economics. But here's the catch: reviving Venezuela's oil sector will take years and tens of billions of dollars, and it depends on political stability. If the new government can't govern, if unrest disrupts operations, or if investors pull back, that hopeful production rebound may never materialize. So right now, markets are pricing in a best-case scenario smooth transition, cooperation with foreign investors, and infrastructure rebuilding, while gasoline prices at the pump lag behind crude markets and regional effects vary widely. The psychological effect of all this hit harder than the economic numbers. The belief that America controls its energy future, secures trade routes, and reduces dependence on foreign oil influences both policy debates and voter mood, even if pump prices barely budge. Europe's role is part of this pressure campaign too. While U.S. forces moved in Venezuela, European capitals have used financial tools to tighten the squeeze. Several European governments have extended asset freezes and stricter sanctions on Venezuelan officials and entities. Banks in London, Frankfurt, and elsewhere are under orders to scrutinize any transaction tied to Venezuela, and insurers are reevaluating coverage for tankers linked to the country. If a ship can't get insured, it can't move crude. If banks won't clear payments because of sanctions, contracts stall. If assets held abroad are frozen, liquidity dries up. That's how economic pressure works in the modern world. Military action on one side, financial containment on the other. For Venezuelan elites, this crisis is existential. Wealth parked in European accounts, property abroad, and international investments can suddenly be inaccessible or frozen. That squeeze weakens their political leverage and gives Washington negotiating leverage, not just over Maduro's close circle, but over whoever steps in next. The signal is straightforward: cooperate and protect your interests, resist and face economic isolation. But the real question that barely gets asked is simply, who is actually running Venezuela now? Competing claims have exploded. One faction in Caracas insists today governance stays in local hands. Another opposition leader has put forward a rival presidential claim. Vice President Delcy Rodriguez appeared on television asserting she still leads. But in practical terms, governance is about who signs oil contracts, who controls revenue, who secures investor protections, and who commands security forces. That clarity is nowhere to be found, and uncertainty paralyzes everything. Oil companies won't commit billions if they don't know who has authority. International banks won't clear payments without legal certainty. Shipping firms won't move cargo without insurance guarantees. So we are left with three possible futures. One, a controlled transition. The United States helps broker a political deal between remnants of the old government and the opposition, setting up a transitional authority, renegotiating oil contracts, and restructuring revenue flows. That's the best case path, but it requires cooperation among rival factions and years of institution building. Two, fragmentation. Internal division deepens, governance breaks down, investment stalls, and chaos drags out, leaving no clear authority to manage the country's strategic assets. And three, which we'll explore next, a hard pivot into regional conflict dynamics that reshapes how nations think about security and economic leverage. Verified developments backing parts of this framing European sanctions and asset freezes. The EU has renewed restrictive measures against Venezuelan individuals, including asset bans and travel limits tied to ongoing political crisis concerns. Financial squeeze effects. Switzerland has also frozen assets linked to Venezuela's former leadership following recent events. Market and geopolitics context, the U.S. and China are engaged in a broader competition over influence in Venezuela's energy sector. If the Venezuelan government splinters, the future could become chaotic. Instead of a single authority, power could break into regional strongholds, some held by remnants of the old regime, others by opposition factions, and still others by criminal networks that fill the vacuum left behind. In that case, oil production stays disrupted, investment dries up, and the humanitarian crisis deepens, a scenario that echoes the prolonged instability seen in Iraq and Libya. Another possibility is external counter-pressure. China and other powers may reject the U.S. outcome, quietly or openly supporting resistance groups, buying oil through alternative channels, and using their ties with other Latin American governments to push back against U.S.-aligned institutions. That would turn Venezuela into a prolonged arena of great power competition rather than a quick transition. None of these outcomes are neat, and the U.S. administration has so far offered limited clarity on which path it intends to pursue or how it will manage the complexities involved. This matters because what's happening in Venezuela now isn't just about one leader. It's about strategic influence and economic control in the hemisphere. The military action itself has made headlines, but the financial and diplomatic measures, including extended European sanctions and asset freezes targeting dozens of Venezuelan officials, are shaping the economic battlefield as well. That dual pressure, military on the ground and financial isolation abroad, squeezes elites whose wealth and investments are tied up in international accounts. If those assets are frozen or inaccessible, their political leverage collapses, giving Washington and its partners negotiation leverage with whoever emerges as the next authority. The message from Western capitals is clear: cooperate, and economic barriers may ease, resist, and isolation deepens. But in Venezuela today, authority is fractured. Competing leaders and factions are making claims, yet practical control over oil contracts, revenue flows, security forces, and legal authority remains uncertain. Without that clarity, oil firms hesitate, international banks won't clear transactions, and shipping companies won't commit cargo, all because legal and logistical frameworks are unresolved. That leaves three broad paths forward. One, a negotiated transition brokered with local factions that establishes a temporary authority, renegotiates energy contracts, and restructures revenue, the most orderly route, but one that requires cooperation and time. Two, deeper fragmentation, where rival groups carve up control, production remains stalled, and chaos persists. And three, sustained geopolitical competition, where external powers like China quietly counter U.S. influence and leverage existing economic ties to reshape regional dynamics. None of these are quick or guaranteed, and there's no clear endgame yet articulated by policymakers. What we can say is this: the economic contest in South America, especially over energy and strategic positioning, is no longer background noise. It's central, and the stakes are not just headlines about an arrested leader or press conferences, but who controls influence, resources, and economic networks in the Western Hemisphere.